Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, November 14th, 2023. It is 1:56 p.m. Eastern Time. I'm starting the video, so we still have about 2 hours left in the trading day, and I just wanted to do a follow-up video on the home builders sector ETF that I just got out as a swing trade idea. You can use XHB. I'll go over that in 1 second. This is ITB, a little bit more of a concentration in the actual builders. And the reason I like to do these videos is exactly this. Many times I've shared my thing that I've kind of made up in trading. It's the kind of a spin off the know your customer rule. When I used to be a stockbroker, you had the FINRA rule that says you have to know your customer, know their situation, so you can make appropriate recommendations. Well, I don't make it recommendations anymore. I share what I see, I give analysis. You take what you want to take, pass on what you want to pass. But what I do think is important, I have a rule that's called know your security rule, and that means know what you're trading. For example, this is ITB. And as I always say, and I said it in the video earlier today, an index or a sector is simply a sum of its parts. And those parts are, in an ETF or a sector, the individual stocks that they hold. And so we're going to go over that because I think that's important. So let me just add some lines here. I had this one on there today. So this is ITB. And I'm going to get into the components in a second here and talk a little bit about the components of this. We'll go over a few of the charts, not all of them. There's a lot of holdings in here. I'm showing there's on my watch list that's to the right of the video. You can't see it. I'm showing there's 45 total stocks in this ETF. So I'm only going to go over the biggest ones. That kind of give you an idea. And it'll also speak to what I just said about know your security rule, because they're not all home construction stocks. They're not all home builders. You do have your DH Hortons and your Lennar and Pulte. They're all in here. Toll Brothers, all the big home builders. However, some of the biggest components are companies that don't build homes, such as Home Depot and Lowe's and Sherwin-Williams and things like that. So that's the know your security kind of thing. And so therefore the takeaway is, if you are, let's say you want to be more specific in short only or go long only the home builders, then you're better off just picking those individual names and going with the most bullish or bearish charts on the individual builders. But there is safety in numbers. That's why ETFs are so popular. One size fits all. You have diversity, at least within that sector, and you don't have to worry as much about being caught on the wrong side of a big earnings miss or beat as when you're trading individual stocks. Okay, let's get on to the charts. So this is ITB, and there are a lot of moving parts on the chart. That's why I figured I'd do a video on it instead of just notes. So the last time that I was started focusing on these as a short sector was right here. You had this beautiful bearish rising wedge pattern. And very much, and this is again why I like to do these videos, it's all about the narrative. The stock market is not about the economy. If you've done this long enough, and you've probably heard it on TV, that the stock market does not mirror the economy. It is kind of its own thing. Ultimately, it will follow. Don't get me wrong. You go into a big recession, you're going to have a bear market. You go into a big economic expansion, you're going to have a bull market. But it doesn't happen day to day. The lag time, just like the lag time on interest rates, can be pretty significant. So let's do this. So just recap. Okay, so you can click on ITB under this post. It'll bring you to all the previous posts. So the latest trade we had on ITB, if you don't count gaming the bounce, would be shorts, where I started highlighting it in the swing trade idea video back on August 4th right here, and I gave you some of the notes that or maybe I didn't. No, I didn't give you a link. But this is just a screenshot from the video. You can see we're on YouTube here. You can go to the site. And that's the primary uptrend line, and there's that beautiful little bearish rising wedge. And again, I'm doing this because if you listen to this video, and you can pull it on the site, pull it on the YouTube channel, the narrative was they were foaming at the mouth bullish at that point. And I even, as I started to segue or roll into covering this as a short trade idea, I looped back to the sector I previously did the same thing to. It was the leisure and restaurant and leisure stocks. So if you recall, just a couple months earlier, right at the highs, I started getting bearish and giving you a bunch of short trade ideas and personally shorting numerous leisure and restaurant stocks. And that includes airlines, hotels, cruises, casinos. Those are your leisure, discretionary spending things. Because again, the narrative had just reached that kind of crescendo, if you will, of bullish cries where everybody, all the marching out the bulls on TV saying the consumer's so resilient, they're just going to keep eating out and they keep spending. And, you don't short a sector because you have that fundamental backdrop and because it's being recognized. It's a combination of two things. Again, when it reaches the kind of, again, a crescendo peak of bullishness and everyone's singing the same song, but then the charts have to confirm it. And then you had the same thing here with the home builders. And they were, March one, pundit after another out on TV that was from 101 reasons why you wanted to buy the builders and why they were so profitable. But yet I went over that in this and addressed those same very things that, shortage of existing home sales on the market drove a lot of money into, forced a lot of folks into buying new construction. And yet, how much of that's been priced into this move, which it was. And so that was the breakdown there. That's right off the highs. And, the video went on to cover XHB, which, as I've just mentioned a second ago, that's your other home builders ETF. You can go with either one. That had just broken down as well. And as I like to often say, too, if you're going to trade a sector or the markets even, you want to make sure the other related sectors or the other indexes, for example, NASDAQ 100 breaks down, it's really going to help to see the S&P 500 break support because I've seen one sector, related
10 plus
sector,
15 years is locked in at 3.
break down, and then the other one holds support, and then that proves to be a whipsaw on the first one. So anywho, you can, again, reference that. That was it and how it played out. And that was the next trend line. And again, I'm going to move over to the charts now. That was then, this is now. So here's how that played out. There was that short entry there. I'm going to guess just like today. Again, I'm being a little bit not facetious, just kind of recognizing patterns and what happens. Very few, if any, want to short the home builders today. I get it. Very few, if any, want to short the stock market today. I get it. And I'm sure very few wanted to short here, but I just, from doing this long enough, I'm sure a lot of folks wanted to short here, and here. And that's where I said, hey, guys, time to cover. I personally took profits on T4 and said the odds for reaction really good. We had positive divergence coming up to the bottom of that T4 zone. And as I quoted in there, there's a link to that. I said, if this support level holds, good support here, and these divergences play out, positive divergences, then we could have more than just a little bounce. And that's exactly what we had, more than just a little bounce. So why am I doing this now? Well, we've come full circle. That is, and like I said, there's a lot of moving parts. And again, this is why I do these videos. So I recognize what appears to be a bull flag continuation pattern or bullish pennant right there, which if you take depending on how you do it, I might have measured the impulsive lift from right here. Let me see what I did do. No, I did the whole thing. Yeah, I did it. Okay, from right here, this is the green candles. That's where we started to take off. So here's how you get the measured target for a bullish continuation pattern like a pennant or a bull flag. You take the flagpole, that's the impulsive move up, leading up to the flagpole. Then you put it at the bottom, the lowest part of the flag just before the breakout. Okay, so this gives you the bull flag measured target. Okay, Randy, why aren't you waiting till we get there? Well, that's what I said in the post I put out today. You very well can. There's a couple options. And I only listed 2, but there's numerous options. Option number 1, pass if it's not your cup of tea. That's a given, so I don't have to say that. Option 2 is, take a full short here. We're downtrend line resistance. I made the case today to short the equity markets. And therefore, if the equity markets fall, the major indexes, this will probably fall. However, if you look at it this way, the other option too is, if you just did a hard short here, meaning a full short, then you're giving yourself, like I said, to my 5th target about, I did a wider stop on this one because I have pretty high convictions that even if we push on up, make that marginal new high. So for me, it's almost an 8% stop up there. If you wait to a max stop on a either a daily or weekly close above 94, a little less than 8%. But this is my new current final target here, and that's 42% to the downside. So you're talking a 4-to-1 risk reward ratio, meaning you're risking $1 to make $4, right? Again, if I'm right. Now, as I also added in that post, again, these are all the moving parts I talked about. If we start to get down here, and I think the magic number will be here, that was this support level right there, about 65.50. That's going to change things for a lot of stocks, more so the individual stocks on this longer term weekly chart. Big negative divergence here. But again, as I'm about to go through the major components, just like the stock market, I think if we get anywhere down, whether we make the marginal new high or not, when we start getting down towards here, this is where we should be in what the Elliott waivers call a P3, primary third wave down, meaning that the late or the November to early January highs in the stock market and the NASDAQ and S&P back in 2021, that was the top end of the last bull market. Here, let me do this. Trying to explain it. Again, just going simplistically this way, kind of a bigger picture count. Wave 1 down, a bear market, first bear market rally, P3 on a primary third wave. It's always the largest, fourth wave, and then a fifth wave to end a 5-wave corrective cycle. It's going to play out big if that does. Okay, so I don't know. I'm getting 5 steps ahead of myself like I usually do, but what I'm doing is sharing my thought process and how this trading plan might evolve, because I don't always have rigid trading plans. I have kind of a rough sketch, and just like right there, same reason I covered when these targets were laid out before, and I had T5 down here, but when we got down to the bottom of T4 zone, as I said in that video, and I encourage you to go back and watch it, the link that I gave when we hit this target, it wasn't just ITB. That was when Apple and QQQ and everything else had just hit or were around their 200-day moving averages. They were at big support. They were above, all my Mag 7 stocks were above those purple key support levels that they successfully defended, positive divergences. So it wasn't one thing, it was many things, and those many things did play out. And so that's where a trading plan is modified. That's why I still think I'll hit T5. It's just I sidestepped these. I wish I could tell you I went long and gamed all that. I didn't, but I certainly sidestepped all the give back, and now it's time to get back in for me. So I would rather get in here because of the heavy economic calendar. This is a perfect setup. Just like I couldn't predict where the CPI was going today, I just said here's some things to watch and react if it does. Same thing this week with the economic calendars, including jobless claims later this week. Jobless claims it's not as big as some of the other ones like the ADP report and some of the other, but it can really shake the markets. The thing is, it's a weekly number, and so it's kind of gradually evolving, and one little week could be viewed as just a kind of an errant spike. But again, there's a lot on the calendar this week still and going forward that can suddenly put the brakes on this rally. And so therefore, if that happens, in hindsight, if it happens, if we get a sharp down, market suddenly reverse on a bad economic report or some systemic shock to the system or anything, then you might miss an opportune entry. So I would rather get in here with room to add, more of a, when I say hard in, it's not an all-in moment on anything right now, short that is. But that's it. You can scale, like I said, up to, but not below the bull flag. That'll give us a marginal new high, and then you have a, if the bull flag targets hit, that's why I have a stop, and that's why I'm giving a little room on a daily or weekly closing basis. And so that's it. Now let's get into the chart. So the negative divergence is there. Here are your top components. And as usual, I'm going through, I have a watch list that contains all the components of ITB, and it's sorted by market cap. Not necessarily, when I do this on these ETFs, it doesn't know the ETF's holdings. Sometimes the largest market cap stock in there is not necessarily the largest holding, and I can't tell you right now. But I can tell you Home Depot matters. So here's Home Depot. This is a daily chart. And like everything else recently, positive divergence. And, you've heard me say this once. You've heard me say it 1,000 times if you followed me. When a stock is heading into earnings, if the technical posture is indiscernible, it's a complete crapshoot. You might as well flip a coin as to whether the stock is going to go up or down after earnings. However, if the technical posture is clearly bearish or clearly bullish, that more often than not, which I always say is not the same as always, more often than not just means more than 50% of the time, the stock is going to go in that direction. Well, here's a clearly bullish technical posture leading earnings. You put in positive divergence. You started to move up. There was even a little trend line, little downtrend line there, a little wedge break. You could probably see it better on the 60. You were moving up and still above that divergent low, and then they reported today. And the funny thing is, and this is the other thing I say all the time, it doesn't matter what earnings are. I can't tell you how many times I've seen a company blow the cover off the ball with earnings only to be sold off, and then in some cases mark an absolute top in that stock, trend change and big correction or bear market followed. And likewise, I've seen abysmal earnings that they missed by a mile only to see the stock up either that following day or and that's really the turn in the stock. So let's just look at Home Depot's earnings and we'll study the chart a little. Well, let me look at the weekly chart here real quick for you as well. So what you have here, this is our primary uptrend line off the 2009 lows. You got the 09 lows, this 2011 low, COVID lows, and then this little spike low. So Home Depot, you zoom in, has just broken the primary uptrend line and back tested. So longer term, weekly, this you could back test for a while. That puts the stock in a precarious technical posture. But I tell you what, to be safe now that we've double tested this level right here, about 275 or the recent lows, that's what it needs to take out. So I'm putting a little more time on going over Home Depot only because it is one of the largest. But then back to what I just said, when you look at fundamentals, you go to, Home Depot missed. They didn't miss. I'm sorry. They had all stocks. They manage expectations, but here's the report. I'm just going to read some things out loud. You can Google it yourself. Home Depot's earnings are downsizing as consumers pull back on their HGTV dreams. They reported Q3 earnings on Tuesday morning. That was today. Sales are down 3.1% over the year, although it just, that was a little less than Wall Street's expectation. Revenue came in a hair higher, adjusted earnings. And again, like all companies, they manage earnings. But overall, it sounds like a pretty lousy report. Foot traffic dropped 2.4%, higher than the 1.27 expected, but the average ticket dropped less than expected, but it still dropped. CEO said he saw continued customer engagement with smaller projects and experienced pressure in big ticket discretionary categories. So go ahead, read through it if you want. Again, it doesn't seem like a rosy report, but yet the stock was up 6%. Why? Well, because that soft CPI report today, which is again priced into the charts technically. I've been looking for a pullback in rates. I didn't know which way this one would go. But what I think the narrative now is going to be going forward in the coming weeks, as far as bigger picture, guys, macro, is you're going to see this rally we're getting now in the stock market, relief rally. And I don't know if it ends today or if it ends in a few weeks with that marginal new high, somewhere in between. Again, my upside alternative scenario targets aren't much more above where we are right now in the equity markets. I see limited upside. And so what I think the market will turn its focus to, so they're cheering the lower interest rates, but if I'm correct, soon we'll start to see more of this, more of what Home Depot reported, and more of surprises on the jobs numbers. And so that's it. So look for jobless claims, look for the various, ADP, all the other employment reports. And those are the kind of known and predictable reports you can watch and come out. And then I said, there's always, I don't call them a black swan anymore. I was trying to, what I made up a term for it the other day. We'll call it, I don't know what you want to call it, an orange swan, whatever. In other words, if there's another, big bank failure or non-financial or anything that is due to something breaking from these rising rates, to me that won't be a black swan. To me and others, it's not a matter of if that happens. It's more a matter of when and where's it going to come from, kind of thing. So those are the two things that will ultimately turn the market and put the brakes on the rally. And again, that's the jobs market rolling over, and or some other systemic event. Okay, let's look at the rest of them. Lowe's. See, Lowe's kind of, and that's the other thing, guys. With Home Depot and Lowe's, like the stock market, including the NASDAQ really, but especially the big indexes, the diversified, and this thing peaked. Home Depot had a wedge back here on the weekly chart, and this stock has long since peaked. It's in a trading range. Is it going down recently? No, it's in a sideways trading range, but it's already down almost 40% off its bull market highs. And when I look at this chart, again, I see the big divergences leading up to it. And that's what I'm doing here when I jump to the weekly charts. I'm looking at bigger picture. And most people just don't have the patience or the time to trade it. And I'll tell you, you can't position and hold this, forever as a short, waiting for this. It's best to just kind of get in and out of these waves. And that's why I'm doing this video. I think it's time to get back into the home builder short. I wouldn't be doing the video. All right, Lowe's also peaked back there when the stock market, a little bit before. And again, these are important tells. I use FedEx and UPS as well as ADP and Paychecks as kind of gauges on trying to get a feel or an early indication of when the economy is rolling over. Well, when Lowe's and Home Depot peak, that's a pretty good idea. And you can see Lowe's had a little uptrend line right here. Let me tighten it up. That's it right there. Nice uptrend line on the weekly. Breakdown, hit support, horizontal support, back test. 200 days, we're below the 200 days. We're about to back test those from below. Our 40 week on the weekly chart here. So that's that. Let me look at the rest here. Sherwin-Williams holding above trend line support. I'll give it that. Also, but it's also well off its highs. That's a weekly chart. There's a daily chart. And we want to probably take that trend line. That's the same trend line, so I'm going to set a price alert. And this is a big one. Obviously, this goes to everything, to new home construction, to remodeling, people selling their homes, buying new homes. I think you all know what Sherwin is, a big paint company, right? So obviously, if they're selling a lot of paint, either a lot of homes are being built or remodeled or getting put on the market to be sold. And again, it's one of many. Not a home builder, but it's certainly in the home construction index for that reason. DHI, DR Horton. Again, so many of these stocks had these little divergent lows and they're popping. But the bigger pictures they put in, they're coming off much bigger divergent highs. And I think it's time to either hard short or scale in. Start getting back in. And if you want to play it safe, you want to wait for a decent sell signal or sign of reversal, absolutely your prerogative, or pass, like I said, if it's not your cup of tea. But that may come on a big gap down that might deny your entry. That's the only problem with that. So you know me, I'm usually a little bullish, a little too early, and a little bearish. Both bullish and bearish. Flipping, covering, reversing positions. Quite often I'll nail the top or bottom, but and then sometimes I just get it dead wrong, as we all do. But again, I would rather in a lot of these, just kind of my read on the market, that this is just a hot, big, massive, fat short squeeze, and unfounded reaction to a fall in interest rates that I think is a little too late. Even if my bullish call on Treasury bonds does play out to the full extent, I think the you're just seeing that initial, short covering rally from all these home builders and Rocket Mortgage and all those guys that are flying right now on the pullback in rates, things like that. Pulte. And you can see, and I'm not going to go through many more. I'm going to wrap it up, get the video out to you guys. Pulte, just like the ITB, I showed you a bull flag continuation pattern. There's your flagpole where you can measure it from that point there, and then you put the flag. So, like I said, at best, I see a little more upside from where I got this video out to you. These guys were at their highs. They pulled back a little bit. So what? Maybe 4% if the full measured target is hit. Quite often those measured targets are. but I don't want to miss the turn on these guys, and I'm more than glad to have a drawdown of 4, 5, 6, even 8% on this trade, and then big negative divergence down here. So again, we had a divergent high here. This is where I highlighted this one right here as a short, individual short if you want it, before it even broke down. If you shorted on the breakdown, the stock fell 15%, but like everything else, not everything, but most everything I was highlighting, and then you had positive divergence. You had price support. I had that 70, 50-ish target there. It hit, dipped slightly below to come down and test the 200-day moving averages. See them perfectly right below. And that's it. So this is just the initial tag. The same reason a few weeks back I was expecting a bounce, favoring a bounce in the market position for it, was just the initial test of the 200-day. First test in a while since we broke out early in the year. Not just for, I'm looking at Pulte here, but I showed you that in the NASDAQ 100 and a lot of those big market-leading tech stocks. So, is it off to the races like that? If you think so, then you buy here. To me, it's just a reflexive bounce. And bounce that'll be faded anywhere between here and maybe a few more, 5 to maybe 8% higher. Builder, again, I can go through them all, coming off the divergent high right here, still below its downtrend line. And I'll probably stop here because, again, there's 45 items in this watch list. Toll Brothers is in there, and Owens Corning, fiberglass, stuff like that for your house. What else? Trex, you make fasteners. Trex looks better than most. And that's why also you can look at these and, kind of avoid if you want to short the most bearish charts and either go long or just sidestep. If you can go long or short ITB, you're shorting or going long all these stocks at once, just like the S&P 500. So that's why you can usually outperform the market by just trading sectors. I mean, if you want to just focus on the 11 sectors in the S&P 500 and, such as financials, which just hit major downtrend line resistance today. I meant to cover it in the earlier video, and I'm going to stop now. This is not related to home builders. Kind of is, maybe, banks and mortgages and all that good stuff. But guys, remember this triangle pattern I was highlighting recently in XLF? There it is, nice and clean, which we hit. Perfect bounce off the bottom of it. Well, guess what? We just hit that today. So this is another reason, in my opinion, to short. I doubt we're going to just blast right through there. If we do, at best, we're going to have to come back and back test it. I've done this long enough. Anything's possible. I'm not saying we can't do it, but to just blast through there and not look back would be very unusual. Chances are at least a pullback or reaction in the financials, and if that happens, you see the banks coming down, you'll probably see the market come down with it, especially the S&P 500. At minimum, we'll probably want to backfill today's gap. At most, could be the end of the run because we just rallied into primary downtrend line resistance. So, all right, I'm going to wrap up here, get the video out to you guys. I'll keep hunting for ideas. Like I said, probably a very good time to be sector selective, long the most bullish, short the most bearish, and of course asset allocation. I can't impress that enough. Stocks are one asset class, bonds are another, commodities are another. Even within commodities, you have various commodities, precious metals, industrial metals, agricultural, crypto's a commodity. We're still short Bitcoin. It's been pushing our upper limits, but it's not taking out the recommended stop and starting to roll over on a day that the market's really strong. So that one was just a poster child of hype. If you've been reading all the headlines recently, a lot of crypto sites or crypto related sites have been pumping out about a 90% probability that their ETF would get approved, and all these private equity firms like BlackRock and all that having a stake in there, but yet private equity is, last I looked, kind of sucking wind a little bit. It's up today. Let me see. Yeah, it took out the trend line like the stock market, but you can draw a lot of resistance levels. I don't have a position in private equity now. We did before. We shorted it way back here somewhere, but it's just kind of been in this big range. All right, I'm digressing too much, but financials, like I said, are at that resistance level. The primary downtrend line, So far, Bitcoin has finally rolled over after backtesting that bearish rising wedge. So that's also still an objective entry. I mean, if you look at it that way on Bitcoin, because the short was here, backtest was here. Said, you either break down and go down or you backtest and roll over. And so now that we've already backtested, I always say this, the problem with backtesting is you can continue to backtest at higher and higher levels and still keep backtesting a trend line. What I like to see is an impulsive rejection off there. And so now that's a hard stop. It has no business. Not to say they can't do that and then fall, but that's where I think a hard stop should be placed. In other words, Bitcoin or GBTC should not take out the previous highs at this point if you're in that. All right, I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.